Alright, what's up YouTube? Welcome to my channel, and in this video I'm going to be going over an important concept that I think is something every new investor out there needs to know and make sure they understand before they begin investing in anything really, whether that's stocks, bonds, ETFs, gold, silver, Bitcoin, Nyan Cat videos, whatever you want to invest in. But before I go any further, YouTube stuff down below, leave a like, comment, and if you just so happen to stumble across this video and you like this type of content, please consider subscribing. Okay, but enough jibber jabber. Let's get into the crux of this video. So I see a lot of new investors who get into the financial markets flocking to companies that are familiar to them. And I have Disney pulled up here, which I'll talk about them specifically in a bit. But the concept I want to address in this video is a very simple one, and I think it can be illustrated by a pretty famous business quote that goes like this: price is what you pay, value is what you get. Now I'm going to say that again so your ears can hear those sweet words one more time, so they can constantly be reminding yourself of them. Price is what you pay, value is what you get. So I'm going to use a more understandable example here that doesn't involve finance to really illustrate this point. So here I'm looking at pants at Old Navy. And you can probably tell I'm looking at whatever these are, like built-in flex jogger pants for men. And they cost $45. Now let's go look at Lululemon, and we can see a pretty similar style of pants, except these cost $138. Now, why is that? Why would people spend $138 on Lululemon pants when they can just go over to Old Navy and buy similar pants for $45? Well, it's similar to what I said. Price is what you pay, value is what you get. If I buy these Old Navy pants for $45 and then they last, say, 5 years before they have a rip in them and I need to throw them out, I got, $45 worth of value in 5 years. If I go to these Lululemon pants and say I purchase these instead, these are most likely higher quality pants and say they last me 25 years. I'm getting better value there, 25 years of pants for $138 than I am 5 years of pants at $45. Because after 5 years, I'm just going to need to spend another $45 to replace those pants. So that is the price value trade-off. And yes, I do own some Lululemon pants myself. Would you pay $138 for these Old Navy pants? No, because the value, or the price rather, significantly exceeds the value, and it's just not worth it at that price point. So you need to look at stock prices as if you're out shopping for pants. The company's fundamentals are what provide the information needed to determine the value. The price merely reflects what the public has generally equated the value of that company to be at a certain point in time. So when you examine fundamentals of a company and you see things like above average industry profit margins, stable and growing operating cash flows, a reasonable debt to equity ratio, and a seasoned, experienced management team, think of those things like a clean, fresh pair of corduroy pants that'll last 10, 15, maybe even 20 years, and being able to buy them at a decent price. So yeah, that's that. Let's go back to Disney now. So say if you want to invest in Disney, and your reason for wanting to invest in Disney at present time is because you think that when the pandemic ends and people start going back to amusement parks and enjoy their time there, once people can go back in public, that's a poor reason for investing in them. And I'm not saying your logic is wrong. People will absolutely be flooding to Disney World in 2022 or 2023 whenever the pandemic is officially over and it's safe to do so en masse. But let's look at what their valuation was before COVID became a thing. So we can see kind of early 2018, it was hovering around $100 a share. It then shot up quite a bit. This was probably due to the announcement of Disney Plus, which we're going to talk about. But you can see their current value when it's been a full year since they've really been able to have a lot of people in their amusement parks. It's significantly up from where it was at any point in time prior to that. We can look at the full year history. I mean, they're basically at an all-time high right now, which doesn't fully make sense because we can go down here. We can see in 2020 they actually lost money versus in previous years they were making about $10 billion. So how does that make the company most valuable today? Well, obviously it's due to optimism of whatever's going on in the business. A big thing is Disney Plus. So let's take it one step further, and let's say you want to invest in Disney because you think Disney Plus is an awesome streaming service and you think it's going to overtake Netflix in, say, 3 years in terms of subscriber count, which, is a valid point. I mean, it's certainly optimistic, but it could happen. I got this article here that says Disney Plus currently has this was as of the end of 2020, so they had about 95 million subscribers, and then Netflix, about 204 million subscribers. So, and Disney Plus has only been around like a little over a year, so that's pretty impressive that they're already at those numbers. And I think management themselves of Disney is pretty impressed by that. So yeah, let's try and quickly analyze this and see if we can determine that if, say, Disney Plus overtakes Netflix in terms of subscriber count in 3 years' time, is Disney a buy at their current valuation? So I've got this Excel analysis set up here, and I know there's a lot going on. Don't worry about it. I'm going to break it down for you. So we'll start with revenue. So this I got straight from their most recent filing, which I have here. So I'll talk about this stuff in a bit, but basically their average revenue per user for Disney Plus was 4.03, and they had about this many subscribers. So their revenue was approximately this much. Now, we also know that Disney is going to be raising their prices by about 30%. So I basically assumed that very optimistically that their average revenue per user for the next couple of years is going to grow by 20%. And this is very optimistic. And I also assume that the number of subscribers will grow to a point where by 2023 they have 240 million paid subscribers at this average revenue per user amount. And let's say that this is enough to overtake Netflix, and Netflix, who have themselves been growing quite a lot. Now, one quick point I want to bring up before I go any further with this is the fact that if, say, tomorrow a news announcement came out that said Disney Plus has overtaken Netflix as the number one streaming service, the stock would go absolutely crazy. And this is just because people tend to overreact to news that they receive in the moment. So when they first hear it, rather than thinking about what it means long term. So the stock price would jump big time on that news. So yeah, that's basically how the revenues will work. Now I'll talk about how I estimated these expenses. So to do this analysis here, all I really did was I took these numbers. So as we can see, the 29, 21 here, which is here, and then subtracted what their expenses were in the past. And we can see it says down here, Disney Plus was launched in November of 2019, which means in here, there's really only 2 months of Disney Plus expenses built into that expense number rather. So for the purpose of this analysis, let's assume that all the increase across these three expense categories is due to a full quarter of operations for Disney Plus. Now, obviously, that's an imperfect measure because there were some increases in expenses related to Hulu and ESPN Plus, which Disney also owns and is grouped into this direct-to-consumer segment. But I think those expenses will cancel out if you kind of consider the expenses that would be included in here for just the 2 months of running Disney Plus. So obviously it's an imperfect measure, but I think for the sake of this analysis that it works. So all I did was take this number, which is just here, and then I subtracted this number, which is there, and then did the same for SG&A and depreciation to get a difference, and then prorated for the full year because this is only on a quarter. And we can see that this number here is literally just a sum of those three numbers. So we can assume that this is basically about what it would cost to run Disney Plus. And I also assume that the business model is perfectly scalable, meaning their expenses won't increase at all despite this massive growth in their subscribers, which is obviously not realistic, but we're trying to keep things as optimistic as we can here. So that's how I got expenses. I already talked about revenue, so all I did was subtract the two to get a profit. And we also have to deduct taxes. I just assumed 25% because they can't get away from paying taxes. I know this is an optimistic scenario, but they can't get away from that. So then we arrive at net operating profit after tax for the next 3 years. I just used a 10% discount rate to reach a present value. And this terminal value here, basically it assumes that this net operating profit after tax, so in perpetuity, which means forever, so in years 2024 onwards, will grow at 5%. And that is obviously very optimistic. I mean, growing at 5% per year, I mean, it forever is obviously something that is unlikely to happen, but again, we're trying to keep things very optimistic. So then if we take the sum of all of these present value of cash flows only from Disney Plus based on these estimates we made, we get to 15.6 billion. So in this very, very optimistic scenario, Disney Plus as a business comes out to being valued at about 15.6 billion. Now, I know what some of you may be thinking. All of Disney's growth can't just be attributed to Disney Plus. And yes, while it's true that their other segments have grown in the past, if we exclude 2020 as kind of the COVID year and a anomaly year, but if we go here, we can see that since then, or year to date, the stock price has gained over 100%. So dating back to March of 2020, since today's March 2021. And that didn't happen because of growth in their other segments. You have to think that was because of optimism surrounding Disney Plus. And based on this analysis we did here of how their market cap changed during the past, or since Disney Plus was actually announced, the market has basically priced in Disney Plus to be about $100 billion business, which even in this very optimistic scenario just doesn't seem reasonable. So keep in mind that Disney Plus surpassing Netflix could very well happen, but that's still a significant reach given the fact that Disney Plus has already just absolutely blown the market away with how fast it's grown. Even Disney Plus's own executives can't really believe it, and we're assuming that it's going to keep growing at this rampant pace into the future. So anyways, going back to the lesson, like I said before, price is what you pay, value is what you get. You cannot make money in the stock market by investing in a company that already has the reason you're investing in them priced into their valuation. Because in that case, all you face is downside risk if the thing you think will happen doesn't end up happening, and then their value ends up just adjusting accordingly. So what you really got to do is you got to put on your investigator cap and begin examining the business to determine if what you think will happen with the company has already been priced in and to what extent. So anyways, there you have it. That's the video. That's the lesson I kind of wanted to make sure people understood. Thank you so much for listening. And again, if you do like this type of content, please consider subscribing. And until next time.